Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets where action was choppy but generally higher. Ross takes a look at gold, silver, crude, gasoline, the U.S. and Canadian dollars, and Bitcoin. Founder of the Trends Journal, Gerald Celente, checks in from historic Kingston, New York, to check out what he expects will happen in this new year. He says with so much wealth being held by so few, Generation Z is tired of being poor and says the election of a socialist mayor in New York could be setting the stage for the next American Revolution. The president of InsideTrackTrading.com, Eric Hadik, examines where we are in the cycles that affect silver, gold, platinum, palladium, crude, lithium, the U.S. and Canadian dollars, and Bitcoin. Author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, talks about whether Canada should be concerned about the U.S. action against Venezuela, especially when it comes to the future of Alberta's heavy oil. Hilliard also takes a look at the state of Canadian real estate and the future of electric vehicles. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Yeah, it's second week of the year, and lots of excitement from last weekend. Venezuela, and then talk about upping the U.S. military budget from $1 trillion to $1.5 trillion. Oh, wow. A lot of good, big stuff going on. So volatility is back in full force.
So how would you describe what happened on the stock markets this past week?
Well, it's a thrashing, but higher. So, initial reactions have been, a small pullback for a few days in the equity markets. Now, as we've been talking, the G7, the Mag 7 stocks are really having some trouble since November. And the unweighted S&P, when you get away from those big names, have been just clearly stepping higher. New highs last week, a small pause, and now back to all-time highs again. So you're seeing that in the Russell and in the unweighted index as far as the S&P is concerned. This, once again, very much like 2000 after the dot-com bubble. And in that case, markets topped and then took a good 4 months to go through a consolidation phase. I think we're moving well into that one as far as the broad markets and the small caps are concerned and the value-weighted items. So, stay away from the high flyers. They may have some big up days, but in general, the move to the upside is definitely being seen by the mid caps at this point.
What's going on with gold and silver?
Once again, volatility. We popped out to new highs in December, pulled back at the end of the year, just right at the end of December. So the gold tested its breakout, small overlap there, but nothing of significance. We're looking at this one just stepping its way higher, and looking at the pullback that we had in October, and measuring from there to the upside, the way we like to measure consolidations and the significance that they then provide to the upside. At this point, We've got targets of 4,700 in gold and 5,300. So, not looking at any long-term targets, but these are short-term measurements based upon the pullback we had in October. Silver has clearly been the one that's been getting all the press. Volatility here as it's pushed up against $80 has been really significant. We got back into the low 70s, and as of the end of the week, we're back pushing $80 again. If we look at the extent of this run compared to other runs, this is still not exceptional by any means. If you take a look at the high that we had back in 2011 at $49, and we measure up from there, a Fibonacci move of 1.618%, 161.8%, gave us a target around 80. If we were to do what we've seen in most of the other examples, we should double that high, so that would give us a target up around $100. The channels that we've been monitoring for the last year or two had been projecting resistance here up around 75. Then beyond that, 125 is the next level to look at, and there's still, let's say, lots of potential. And when you read all the hype that's out there from the people on the fundamental side and the shortage of physical silver, clearly this thing can gain some momentum on the upside. Now, the COT numbers, the commitment of trade numbers, are finally up to date. The U.S. government shut down and prevented the COT numbers from being presented for the last couple of months. They slowly have filled in the gaps. And as of a week ago, we now have up-to-date numbers, and those will be seen again this week. But as of now, the COT numbers in silver are still quite bullish. It's amazing how the action in the upside has not brought in offside levels as far as the commercials or the speculators are concerned. So still upside potential there.
What's going on in the crude oil market?
Crude. This was a sort of a seldom used move on Venezuela. You got an initial break back down to test the support level of the last month or so, and as of this week, it's turned the corner again. We're back up, testing the $60 level. Seasonally, we've been looking for a bottom in December, January. So clearly that one is now setting itself in place, and I would think that a move through $60, which is where the 20-week moving average is, would be the catalyst then for some upside action. Also in the energy complex, the gasoline has been down significantly. It is showing signs of a turn. And in about, probably 70 to 80% of the years, when gasoline has been down into December, January, there's been a good rally out of the bottom. So gasoline at this point should present itself as a good opportunity.
What's going on with the U.S., Canadian dollars, and Bitcoin?
U.S. dollar is coming off the bottom. A week ago we didn't feel that there was any guidance in there, but I guess with what we've seen as far as the U.S. Military might is concerned, the trade numbers that came out this week, the dollar has had some buoyancy again. No breakouts, but just back into the middle of its last month or so trading range. So at this point, it's got some upside bias, but nothing to write home about. The Canadian dollar, though, with this update from the government on the COT numbers, has given an outright sell signals. We look at the relative strength of the COT numbers themselves, and we look at the Bollinger Bands. Both of those are up into sell territory. We haven't seen this in months and months. So this is not good. There are just too many bulls in here on the Canadian dollar. And if we take a look at the way this week has unfolded, with the oil market coming back and the Canadian dollar not, then the implication is that what we're seeing in the way of oil, for all that it's going to take years to get the production up and running in Venezuela, it is not good for what we're seeing as far as Canada is concerned. And at this point, the easy move here is on the downside. On Bitcoin, we've been looking at this as having created a base. It had just the capitulation low initially, went through a normal consolidation, and then a week ago, moving averages, short-term averages, crossed to the upside, which was bullish. We got an initial spike of a couple of days, and it's pulled back at the end of the week. We're into a support area. We're looking at the 20-day moving average is a support, and with 90,000 is a key level to watch. On the upside, initial resistance at 95,000, but the width of this consolidation, the time frame, suggests that we could see a move with greater magnitude than we saw on the first bounce. So 95,000 is probably just a starting point for the next move to the upside.
Ross, thank you so much for the update.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, Gerald Celente, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Gerald Celente, publisher of the Trends Journal, available online at trendsjournal.com. He's speaking to us from historic Kingston, New York. Gerald, Happy New Year, and welcome back to This Week in Money.
Well, thanks for having me back, and Happy New Year to you and everyone.
The Trends Journal top trends for 2026, hot off the press. Can you tell us about it and how our listeners can subscribe to receive it?
Oh, simply go to trendsjournal.com, trendsjournal.com. And it's the grand total, by the way, of $2.59 a week, pennies a day. And when I'm saying what we're giving the people, everybody's talking about AI. AI is the future. AI is this. AI is that. Go to Google. Type in top trends for 2026. See what comes up. You know what comes up? This is when we put out the magazine. It is AI top trends for 2026 point towards a shift from 2025's quiet luxury to loud luxury, featuring bold colors, exaggerated embellishments like tassels and bows. Can you make this crap up? This is AI telling you what the top trends for 2026 are going to be.
Oh, AI gets facts wrong all the time. And by the way, tassels and bows are really going to change my life, Gerald. I got to tell you that.
I'm saying,
so looking forward to it.
It's the future. They keep selling it, and no one's giving you the top trends. Go to all the major newspapers. No one did it. This is what happened in 2025. They don't know how to do trend forecasting. They don't teach it at Harvard, Princeton, Yale, Cambridge, Oxford. We have best-selling books, Trends 2000, Trend Tracking, on and on. Far better than Megatrends. Been publishing the magazine, the Trends Journal, since 1991. So I'm just saying we're giving the people everything we can to help them prepare, prevail, and prosper in these times ahead like I've never seen in my lifetime.
Looking forward to all those tassels and bows. Now for the serious stuff. Gold and silver, are they a trend in motion for the new year?
Absolutely. And I've been on your show for how many times? I mean, in 2024, one of our top trends was a golden year for gold. We called the bottom of gold in 2023 when it hit 1850, and 3 months later, we said it's going to be a golden year for gold, and gold went up almost 30%. And last year it went up over 60%, 65%. And it's just going to keep going because it's a precious metal that people want that's a safe haven asset. And in these times of socioeconomic and geopolitical uncertainty, one of our top trends for 2026 is precious metals to shine on. And again, as we're on the air, you're looking at gold prices at $4,496 an ounce. They're up $19 today, hit a high of $4,517 an ounce. You take a look at silver. It's at $79.79, up almost $2.90. And it was higher than that. It was in the 80 range. I mean, it's showing you how bad things are. And this is very clear, too. If there were no cryptocurrencies, you would see these prices doubled. And going back to silver, very important. We talked before, about the AI revolution. It's real. Well, like it, hate it, it's the future. And they're building all of these massive data centers, all of these chips, and silver's used in them. And silver, although the United States isn't going clean energy, a lot of the world is. And silver's used in all of these solar panels and on and on and on. And unlike gold, there are no stockpiles of silver. So, for instance, you say you need some dough and you melt down your gold ring or sell it, you get money for it. There's gold stockpiles, but not silver. You throw your computer away, your cell phone away that has silver in it. So those are some of the reasons why we're going to see it going up. And again, silver has become the poorer people's gold. They can't afford, almost $4,500 an ounce for gold, so they're going to keep buying silver. So we're bullish on both of them.
President Trump thought Bitcoin was a scam. Now he likes it. Was President Trump right then or now?
You put your money where your mouth is, and that's where they're putting their money. Look what happened when he ran for office. He got over $100 million from the crypto people. What happened with his inauguration? Tens of millions of dollars from the crypto people. His kids in the crypto business. You got Lutnick Witkoff and his cabinet and his administration. Their kids are in the crypto business. Family, friends, the people in the cabinet, him. So we're bullish on it because one of our top trends is Bitcoin or Bitcon. The Trumpsters are running the show. Again, it's not what you like, what you want. It's what is. And that's the what is. That's the fact. And you said it. He was made fun of Bitcoin before. I don't want to say exactly what he said because I don't want to get sued, but to the effect that it was a scam and it was killing the dollar. But now that his family, friends, people in his administration, their kids are in it, we see it going up.
Do you think World War III has started?
Oh, it started when the Ukraine war broke out on February 24th, 2022. And now you're seeing what's going on in the Middle East. Again, bombs away, Israel bombing Lebanon. The Gaza war keeps going on. More talk about bombing Iran. Iran's in chaos. And now Saudi Arabia is bombing Yemen. Trump, again, who sold himself as a peace president, and you remember his New Year's Eve resolution, and he was going to have peace on earth, and a couple of days later he's bombing Venezuela. And they bombed Somalia. He's bombed Somalia when he was president over about 130 times. So no, World War III is going on. There's going to be a false flag event that makes it, quote, official. And that's what we're very concerned about. And you see Europe building up their military. Germany in recession for 2 years, barely growing in 2025, like 0.2%, spending $1 trillion to build up their military and their infrastructure that could hold the tanks. And this is Germany, third largest economy in the world, largest in Europe, in recession, and building up their military. And one country after another in Europe building up their military. One of my lines is, when all else fails, they take you to war, and the global economy is failing. And if you need any more proof that the global economy is failing, again, just look at gold and silver prices. It's a precious metal, and it's a safe haven asset. That's why the prices are skyrocketing.
What is .com bust 2.0?
Trends are born, they grow, they mature, reach old age, and die. .com, the AI revolution, or evolution, only began in, mid-2022. It's an infant. You don't invest all your dough in the baby. And that's what they're doing. Now, you go back to our Trends Journal when it was a quarterly, now it's a weekly. Back in the autumn of 1999, we had forecast a .com bust. We said it would bust by the second quarter of 2000, and it did. NASDAQ dove some 80%. Now let's go back to AI. In tracking trends, you make connections between different fields. Again, it's not what you like, what you want, what you wish, it's what is. Go back 25 years ago. China is brought into the World Trade Organization by Bill Clinton. 10% of Chinese 18-year-olds had gone to college. 10%. You know what it is now? Nearly 70%. You got a country of 1.4 billion versus what? 343 million in America? Oh, and they're not taking college courses in transgender studies over there. They're very advanced people. You don't believe they're advanced? Who's leading the world in EVs? BYD, what's that? Nobody. Most people have never heard the name. The United States and Western Europe gave China all the high-tech and heavy industry technology they never had when they were brought into the World Trade Organization, so the manufacturers could go there and get cheap labor. Now they got everything that they need. Now let's go back to AI. China is investing very heavily in AI. Let's go back to last January. DeepSeek. Oh, DeepSeek. Oh, yeah, that Chinese AI company that said, no, we don't need $100 million to do this. We did it for $6 million. No, we don't need those big chips either. And that's what's going on. China's going to lead the world in AI. And they've way overinvested in the AI companies in America. And if you need any more proof, some 50% of U.S. GDP growth in 2025 because of spending in AI. Way overspending. The trend just began, and it's going to evolve way differently than it is right now, and China's going to lead it, so we're seeing a .com bust 2.0.
Is there a Generation Z or Z revolution?
You know, I'm born in the Bronx. I'm a Bronx guy. I mean, you know, if you're not from the Bronx, you know, it's a different trip of all of New York. I know New York City. And New York just elected a guy that nobody ever heard of a year ago. 34 years old. Again, not what you like, what you want, what you wish for. This Mondani. Nobody ever heard of him. What does he call himself? A democratic socialist. Yeah, I'll give you free child care. Free bus rides. No, you can't raise your rent. Yeah, but my insurance went up. You raised my taxes. No, you can't raise your rent. Oh, I'm gonna have a government grocery store, so you don't have to pay all this money. Who voted for him? Gen Z. They're broke and busted. Again, this is the biggest city in America. This is New York City. We're not talking about Columbus, Ohio here. A little nobody that nobody ever heard of because Gen Z is so desperate. Now let's go global. Hey, what happened a couple of months ago over in a place called Nepal? Oh, you mean Gen Z overthrew the government? Oh, what happened a couple of weeks ago in a place called Bulgaria? Oh, Gen Z overthrew the government. What's going on in Madagascar, Morocco, Tanzania? Oh, Gen Z protests. Kenya. One place after another. The people, they broke and busted. They have absolutely no future. This is real. The facts are all there. There's going to be a Gen Z revolution, and there's probably more of an off with their heads 2.0. Here, look at the facts. Gen Z, okay? The oldest of Gen Z is 28 years old. Once upon a time, not too long ago, the average age of first-time home buyers in America, 28 years old. You know what it is today? 40. Top 10% of Americans responsible for some 50% of all spending in the United States. 10%. 1% own 54% of the equity markets. Put the 10% into it, 92%. Go back when I was a young guy. They had things called hardware stores, stationery stores, shoe stores, drug stores, clothing stores, hardware stores, fish stores. Everything's a chain now. No mom and pops. The young people have no future. Gen Z revolution like we've never seen.
What's the latest on the presidential reality show?
We own the trademark. That's all it is. Says one thing, does another thing. Here, I'm only going to give you the facts. Defense stocks surge after Trump calls for $1.5 trillion military budget in 2027. All right? Let's go back to February of last year. Defense stocks drop after Trump says Pentagon spending could be halved. That's CNBC. I'm not making this up. Hey, wait a minute. You said they're going to be halved from $1 trillion, nearly $1 trillion, and now you're going to say it's going to go up to $1.5 trillion? Hey, I'm going to put taxes on. No, I just tariffs. I just changed it. They came out with this line, Taco Trump. Trump always chickens out. It's a reality show. That's all this is. It's all it is. And he's in total control, like we've never seen before. He says it, I'm in charge. I'll do this, I'll do that. In violation of the Constitution, according to Judge Andrew Napolitano. What he's doing with the bombing of Venezuela, the kidnapping of its president, all in violation of the Constitution. But he's in charge. It's the presidential reality show.
Is tech-itis changing humanity?
Yep. Each week we publish articles almost each week about how it's affecting particularly young people and even older people. They're addicted to their cell phones, their computers, and it's their AI is going to accelerate it in many, many different ways. And like nothing we've ever seen before. Look, go out. You know, once upon a time, we used to hang out at a bar. People used to talk to each other. Now they're on the phone. Look at people walking down the streets. They're on their phone. Look at the data of young people that are addicted. They can't get off it. And what it's doing to them mentally and physically. And how many, now they're banning it in different places when kids go to school because they're so addicted to it. You know, they say in the King James Bible that the meek shall inherit the earth. They misspelt it. The geeks have inherited the earth. No, it's true. Remember, we're old enough to remember there was a thing called instruments? No more. Well, synthesized crap. Everything's synthesized. And so they're totally addicted to this stuff, and it's going to be very dangerous. Again, not my data. Go to the University of California, Berkeley. They stopped reporting this stuff, by the way. If you're on a cell phone for 17 minutes a day for 10 years, your chances of getting a brain tumor only increase by 60%. That's their data. So this is very dangerous. They were banning them in France for years for kids under 12 years old because your brain shield is thinner. And then again, you know, the bigs run everything, so they got rid of that too. So no, this is very. There's more and more addiction to it, and the more addiction they are to this, the less information they really have. Oh, we just saw the Pittsburgh Gazette a paper that was from Pittsburgh, Pennsylvania, that was created in the 1700s, just went out of business. People don't read anymore. It's gone. It's gone. It's AI addicted. It's techitis.
Is artificial intelligence just the next level of computer programming that can't actually think for itself?
Well, no, again, I just showed you the proof about Google up, top trends for 2026. Look at stupidity comes up. But that's fine, because stupidity is the way of the future. So it's going to be it. Period, paragraph. And it's going to keep advancing and advancing and advancing. Again, trends are born, they grow, they mature, reach old age, and die. This is an infant. And more companies are going to be using it so they can have less and less employees so the people running the company can make more and more money, whether it's effective or not. And again, what I'm saying, no one is proving. Again, we came out with the top trends of this year. Go to all the major newspapers, not a word about it. This is what happened in 2025. They don't know how to do forecasting. So they're going to rely on this kind of stupidity. Again, the geeks have inherited the earth. Look what they look like. If I look like Zuckerberg, Cook, Gates, Pichai, I'd blow my brains out. Look at them. Look at the style that they lack. Not a drop of boogie, not an ounce of jive. All teched out, and that's what the world's become.
One of your top trends is Off With Their Heads 2.0. What's that all about?
Again, as I said, you're looking at this Gen Z revolution. The bigs own everything. Here in the United States, again, only by the data, again, the top 10 richest billionaires in America got $700 billion richer last year. Meanwhile, the middle class keeps shrinking. People can't afford to buy. Again, as I said, the top 10% are responsible for 50% of all the spending in America, retail and everything else. There's going to be revolutions in countries against the bigs having everything and the people having nothing. It's happened before. It's going to happen again. This thing's going to ramp up big time. The trillionaires, and by the way, when the COVID war happened, Oxfam, you look at their data, how much richer the billionaires got as everybody else got poorer. And now a bad situation is becoming much worse.
Are we going to see a French Revolution-style revolt in North America?
Yes. You're going to see it all over the world. Most of the world. The people have had it. I mean, look at the unrest going on all over. Nigeria, Somalia, Kenya. It's all over the world. And again, you got to look at this Gen Z thing. Again, what happened in New York City is historic. Again, I'm a New York City guy. It's historic. A little nobody from nothing. 34 years old. Again, like them, don't like them, not the issue. It's showing you the desperation of the people. And when people lose everything and have nothing left to lose, they lose it. And they're going to lose it, man. And again, when you're a young cat, you're not afraid. And that's what they're doing. They're taking to the streets. They're protesting. They're doing everything they can to overthrow the establishment.
I was going to say, what about the riots in Iran right now? Are they going to overthrow that government?
Hard to tell. And Iran's now blaming the United States and Israel for making it happen. Who knows why? And but again, it's showing you the level of unrest. And why is it happening? Because the people are broke and busted. They're broke and busted. That's why they're taken to the streets. Again, when people lose everything and have nothing left to lose, they lose it. It's right in front of everybody's eyes. But they make it, as it's being reported, they make it a political thing. It's not political. It's about people having no future. Again, I'm giving you the data. The average age of first-time home buyers in America is 40 years old. Go back a few years ago, before the COVID war, 28 years old.
So your mortgage isn't paid off until you're 70 or 75.
Yeah. Yeah, it's, again, and then Trump wants to have a, what was it, a 40-year mortgage or something, you know, a 50-year mortgage. I mean, and, you know, some things he's doing is smart, and other things, you know, like he's coming out against these big private equity groups and hedge funds and venture capitalists from owning real estate in America. They own some 20% of the homes in America. I'm not talking about apartment buildings. I'm talking about single-family homes. And that happened when the Panic of '08 happened. Again, I mentioned about the dot-com bust. The NASDAQ, after when it busted in 1999, in 2001, the NASDAQ was down 80% before 9/11. Again, when all else fails, they take you to war. War on terror. Everybody forgot about the bust. What happened? Hey, you don't have a job? You out of work? You're deep in debt? Don't worry about it. Sign over here. We call it a subprime mortgage, all right? And then what happened? Panic of '08 hit. And then what happened? All those people that lost those homes, Blackstone, these other groups started buying them up, buying them up, buying them up. And now they own, they say, around, not Blackstone alone, but the big companies own about 20% of the housing in America, the single-family homes. And Trump's trying to stop that. So that shows you how bad it is.
Are we going to see a stock market crash this year?
I believe so. And it's not going to be the greatest recession. We see the greatest depression. Hey, I'll give you something nobody's talking about. Only the facts. What's your office vacancy rate in Louisville, Kentucky, the home of the Kentucky Derby? They say 40%. Chicago, the Windy City. What's the vacancy rate? 28%. Portland, Oregon. Denver, Colorado. Seattle, Washington. The vacancy rates are in the high 20%, near 30%. When they had the COVID war that was launched in China on Chinese Lunar New Year, the year of the rat in 2020, and made everybody go home, it changed the world. So now, the office leases are up, 5 and 10-year leases, and now we're 6 years into this thing. People are not renewing their leases. Yeah, work at home a couple of days. I don't even have to come in all the time. You're in these cubicles anyway. I don't need all this space. There's going to be defaults on these loans, and the banks don't have the dough to cover it. And if you don't believe me, is anybody talking about the repo markets right now and how much money the Fed's put into the repo market so the banks can borrow money? Let's go back to 2023. Not ancient history. What happened in September of not 2023. Let's go back to 2019. A repo crisis. Everybody forgot about it. Again, I mentioned to you how they artificially propped up all the homes. And now they artificially propped up the markets again. Trump forced Powell to lower interest rates when the Dow had its worst December in 2018 since the Great Depression. Then the repo crisis happened. 2019. Everybody forgot about it. Then what happened? Mm-hmm. COVID war happened. Everybody forgot about it. I'm going back now. We go back to 2023, as I was saying before. 3 banks failed. Signature, First Republic, and Silicon Valley Bank. 3 banks failed. 3. The markets were crashing and gold prices were spiking. You're going to see 30 banks fail. There's no way that they could cover the losses from these offices that are vacant. Condo sales, down. Luxury condominiums in Boston that they built, can't sell them. Look at the numbers in Florida, how the prices are falling in the real estate sector. There's going to be an office building bust that's going to make the banks go bust, that's going to crash the markets like we've never seen since the Great Depression. 1929.
Military spending is going to increase. Is this for peace?
How stupid it is that they're doing this. The next, there was this cat by the name of Albert Einstein. He knew a thing or two about the atomic bomb. They asked him, what kind of weapons will be used to fight the Third World War? He said, I don't know, but they'll be using sticks and stones to fight the fourth. I have best-selling books. One of them is Trends 2000. Back in 2000, they brought me to Virginia Military Institute, VMI. You know why they brought me there? To talk about new millennium warfare. I'm going back 26 years ago. Drones? Never heard of them back then. You're spending all this money on boats and planes and ships and tanks. Waste of money. Total waste of money. And it's destroying the global economy. Germany, the third largest economy in the world, spending $1 trillion. During the recession for 2 years. This year, 2025, the numbers aren't out yet. The GDP may grow by 0.2%. Recession. We're building up our military and our infrastructure so it could hold the tanks, this guy Mertz says, right? Total waste of money. It does not build up the economy. Economies are built up when the products that are made in the country are consumed by the consumers. These products just enrich the military-industrial complex. And again, you look at the numbers. When Trump came out the other day and said he was going to increase the defense budget up to $1.5 trillion, what went up? Oh, the defense stocks. Every gun that is made, every warship launched, every rocket fired signifies, in the final sense, a theft from those who hunger and are not fed, those who are cold and not clothed. The world in arms is not spending money alone. It is spending the sweat of its laborers, the genius of its scientists, the hopes of its children. This is not a way of life at all in any true sense. Under the clouds of war, it is humanity hanging on a cross of iron. Dwight D. Eisenhower, 5-star general, supreme commander of the Allied forces in World War II, and 2-term president of the United States. All right?
Gerald, how can people subscribe to the Trends Journal and receive the hot-off-the-press top trends of 2026?
Just simply go to trendsjournal.com, trendsjournal.com. And again, the grand total of $2.59 a week. And if you don't like it, you get your money back. Now, there's no magazine like it, and I'm not bragging. You go to YouTube and you see the comments of the people that subscribe. Journalism is dead. We're political atheists. We don't take sides. We just give you the facts.
Just the facts, man.
And that's it. And we cover the world. We cover what everybody's saying in every different country, and say this is what they're saying. This is our analysis. And this is our trend forecast. So we give you all the views and then our analysis, not one side like you get in the Western media or most of the media.
Gerald, thank you so much for being on This Week in Money.
And thank you for having me on and for all you do. You really help the people in so many different ways. Thank you so much.
My guest has been Gerald Celente, publisher of the Trends Journal, available online at trendsjournal.com. He was speaking to us from historic Kingston, New York. Coming up, Eric Hadik, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Oh, well, thanks for having me back, Jim. Pleasure to be here.
Can you tell us about Inside Track, spelled with two I's, and how people can subscribe?
Yes, Inside Track is a financial advisory and cyclic technical analysis tutorial service that we offer, addressing the outlooks in the markets, but mainly from a technical and cyclical perspective. And your listeners can find out more information, see a lot of samples, see many of our indicators, a basic explanation of them at our primary website, InsideTrackTrading.com, and that's with the extra I in the middle, so it's INSIIDE, tracktrading.com.
The Dow hit new all-time highs again this week. What are your cycles predicting for the Dow in this new year?
Well, from a cycle perspective, I have been saying that I thought January of 2026 was the time when we would see a more significant peak in most of the indexes. I was looking for some divergence leading into here where some indexes, and in this case it's been the NASDAQ 100, may peak earlier, and while others are continuing to higher highs. You've seen that at pretty much every turning point, particularly the highs over the last 10, 15 years, that you'll get certain indexes give some very strong signs of a top and go through an initial sell-off, and then when there's a subsequent rally, other indexes go to higher highs, that leading index goes to a lower high, and then you start to get that divergent peak. But all that to say is, since we bottomed out in early April and showed that that should be a 1 to 2 year bottom, that my monthly and multi-year cycles were telling me to look for a series of highs in late July, late September, late November, and then finally in mid to late January, which coincided, that January one coincides with a very consistent 2-year cycle and a very consistent 4-year cycle that come into play here in the first quarter of 2026, and in particular in January. And so that is coming together in my work, and I'm looking to see if we can get some of these indexes showing more convincing signs of a top and giving reversal signals. But for right now, most of the trends are up. The NASDAQ 100 is the only one that's gone neutral, but there are still a few things it would need to do to turn negative. And I'm looking at the next 2 weeks as being a very pivotal time in a lot of the indexes.
Dow Jones transports hitting new highs. Where are the transports in their cycle? And do the transports have a special role in telling us where the stock markets are going?
The transports will often lead some of the turning points in the market. That does not appear to be the case this time. Like I said, I think it's a little unique situation for a top where you've got the tech-heavy and the AI-focused NASDAQ 100 showing signs that it might be peaking first. But the transports, I'm more interested in their price action and price levels as opposed to any specific cycles. They share many of the same cycles with all the other indexes, but it's when you see that divergence I was speaking of, that some will stretch out and move to higher highs, others won't. But what's interesting to me is that the transports are just finally making it back above their November 2024 peak and are attacking their November 2021 peak. And that's where you've got multi-year resistance, and it also would fulfill a group of different upside wave objectives and other technical price targets if the transports can retest and potentially spike above that 2021 peak. But what that also shows you is that they have really been in a very wide trading range for over 4 years now.
The U.S. dollar remains in a trading range. We keep hearing about the demise of the U.S. dollar. What are the cycles saying?
Well, I guess that would depend on how you define demise of the dollar, because comparing it to other fiat debt-based currencies is just kind of a deceptive or a masking what's happening to paper currency. If you want to see whether the dollar's holding up or not, pull out a chart of gold for the last 20 years and then flip it upside down, and you'll see exactly what the dollar's been doing versus at least one other major form of currency. And especially these last 3 years since the October 2022 low in gold, the value of the dollar based on gold has just been plummeting. So we're definitely seeing that degradation of the dollar's value. The only place, like I said, that it's masked is comparing it to some other debt-based currencies who are suffering the same fate. But I do think that the dollar index has another rebound here on an intermediate basis. It set those lows in July and then retested them in September, and that was expected to be a 3 to 6 month bottom. But if the dollar can rally up into the second half of January, and I've even been looking at 102 on the dollar index futures as my key resistance level and potential upside target. So if the dollar makes it up there and holds that resistance, which I expect it to do, that would set it up for a second multi-month leg down like we saw from January to July of last year.
The Canadian dollar's been pulling back since last December. Do you have any target cycles or cycle targets for the Canadian buck?
Well, again, I'm more focused on price than specific cycles, but the Canadian dollar has had really its primary support down around 70 cents and primary resistance around 74.5. The way that it rallied most recently from in November and December, it gave some signs of a developing bottom. It was able to turn a weekly trend indicator that I use up, and that is a lagging confirming indicator. In fact, very often that reversal up is triggered right near the end of an initial advance, but it's what it's telling you about the future that's important from that indicator. And so Canadian dollar went through that, peaked. Usually when it gives that signal and tells you there's an initial top, I look for a 2 to 3 week reactive sell-off, and that's kind of where we're at right now in the Canadian dollar. But I could see a secondary low stretch out as far as the middle part of February. But I do think that it is forming a bottom, and that right now I expect that those November lows to hold. The next week or so should give me more clarity on that expectation. But the way things are structured right now, I would expect that to hold as a higher low, as a secondary low above the January 2025 bottom. And so I think that we're in a basing process in the Canadian dollar, but it still has more work to do before I would expect to see any significant advance.
What are you seeing in the Bitcoin cycle?
Bitcoin is still in the throes of some very negative cycles that we discussed throughout last year, that I thought the fourth quarter of 2025 would mark a dramatic shift in several markets, but one of them being cryptos. And November, December, and into January were the first wave of negative cycles in cryptos. So I think that Bitcoin still has another drop and spike low in here. In fact, this past week, it fulfilled some important criteria to reinforce that outlook. One of the things it did was to quick spike up to what is an extreme upside weekly target that I use, and it came into play right around 95,000. And Bitcoin gave a nice quick spike up there, started to sell off. I'm looking at Monday's action to see if it can confirm a new wave down, and if so, I would expect to see some selling into just past mid-January. But I was describing in my monthly newsletter the last couple months where not only Bitcoin and Ether have been giving some very good signals, but the XRP has given some very intriguing signals and has had some pretty consistent monthly cycles that were coming into play in mid-January. So that's one crypto that is kind of giving some additional signs to factor into the overall analysis. So if we could see a spike down in all of those over the next 1 to 2 weeks, particularly if they can set new lows for this correction since November, then I think you'd be in a better position to set a 1 to 2 month bottom in Bitcoin. But there are some more significant and more prominent cycles out later in the year when I think Bitcoin and Ether would still see additional declines into those cycles before a more significant, say, 3 to 6 month bottom would become a higher likelihood.
Does it look like there's more upside in the gold cycle?
Well, I keep talking about, for all the metals, for gold, silver, platinum, palladium, my outlook since early April had been and has been, continues to be, that those metals, particularly the white metals, would see major surges, accelerated bull markets from early April 2025 into April or May of 2026, with palladium even showing it could stretch its final high out into the third quarter of 2026. So they're all pretty much in sync, and in between those cycles, there's been a fairly consistent 3-month/90-degree cycle and cycle progression that continues to govern the metals markets. And that cycle was looking for and was fulfilled with initial highs in mid to late July, mid to late October. In fact, even prior to the July one, gold had set a 4 to 5 month high back in mid to late April. And so every 3 months, there's a little more consistent or more precise weekly and daily factorization to that cycle, but it's approximately 3 months. You've seen these peaks, and so the next phase in that cycle is mid to late January, which is where we're now approaching. And so I think we could see final spikes high in all the metals, and that would also reinforce to me the next phase of that 3 month cycle, which is when many of these other multi-year cycles converge, and that's in mid to late April of this year. So a peak in the next 1 to 2 weeks would not only fulfill a lot of expectations, but it would also corroborate and reinforce some future expectations that there would be an even higher likelihood of a future peak in April. So they're all kind of moving along to in the same rhythm. Gold has certainly lagged as far as its price action, but the turning points are still very similar. And just from a price and wave perspective, both gold and silver, when they saw those initial pullbacks from their late December highs, they were not able to turn their daily trends down. And when that happens, it tells me that it's nothing more than a correction and that those markets still need to go back up and make at least one more new high, which is where we're at in gold and silver in particular. Platinum had a little bit different structure. Palladium had an even slightly different structure from there, but they were showing me that we should still see a spike high. There's some specific price levels and targets associated with that, and I'm watching that price action far more than these cycles. I always say this, and I always use this, that the cycles and cycle progressions are a backdrop. They kind of set the stage, but then it's price action that needs to really filter that and hone that and trigger related signals and strategies. So discussing the cycles is a broader type of discussion, but it's some of these more specific price indicators that really validate those cycles, and that's what I'm looking for in the coming 1 to 2 weeks in precious metals.
Silver over $84 an ounce in late December. We're hearing silver could hit $125, $200, $300 or more. What is the silver cycle saying?
Well, if you're hearing all that, you can pretty much assume you're pretty close to a top, because the people that back in early April of last year, when silver was spiking down below $28 and fulfilling major downside objectives, price support levels, I even put out in April a special report on the 17-year cycle in silver and showed how there was a very interesting phenomenon recurring in silver. That was the time to be talking about much higher levels. Now, where it's clear to everyone and all the fundamentals about China restricting silver and everyone else hoarding silver, now when they're all in the news, that's when you get your Johnny-come-lately saying, oh, well, it's going to go so much higher and so much higher and much higher than that. And that's usually when you get at least an initial peak. And so if there's talk of $200 and $300, you can probably rest assured that we're in for at least a significant correction. Doesn't mean that those numbers might not be right in the future, but when they start touting them as if they're around the corner, that's usually a good danger sign that we're in for a little bit deeper correction.
Platinum and palladium continue to hit new all-time highs. Are they basically in the same cycle?
Yeah, that's, like I said, all the metals are pretty much in the same cycle. Again, back in late March, early April of last year, I did several reports, and one of the things I talked about was platinum, and, it was a little play on words here, but I said platinum could be the golden opportunity for 2025, and that it had been in a multi-year trading range, and that several very significant monthly indicators were poised to bottom out and turn positive in the first half of April 2025. And that's why I thought that was the ideal point to be entering long positions in silver, platinum, and palladium. But the upside potential from a timing and cycle perspective is pretty similar. But as I mentioned before, palladium could stretch it out into the third quarter. And often what you see is kind of what I was describing in stock indexes a few minutes ago, and that is you'll probably see all those metals set initial highs in the April-May time frame, and you'll probably see them all set subsequent highs in the third quarter, but maybe you get silver setting its highest high in April, May, maybe platinum doing the same thing, but palladium spiking to a higher high in the third quarter for whatever reason. And so they would be moving in pretty close lockstep as far as their declines and rallies, but palladium might spike to slightly higher highs, so then its overall cycle would have extended into the third quarter, whereas silver and platinum, if these metals follow that hypothetical scenario, they would have peaked in April, May of 2026. But there's a lot more clarification and corroboration that needs to happen. Again, those cycles are just a backdrop. They provided a very clear target back in April of last year when I was telling my readers to start getting in the long side, that those cycles gave some very specific time parameters for how long I expected this accelerated bull market to last. But in the midst of that, like we were just discussing, you also have your 2 to 3 month cycles that time specific peaks. And as we get into these higher price levels and more accelerated moves, of course, your reactive corrections are going to be that much more significant too. So you want to be very in tune with the intermediate timing indicators and what they're showing if you're looking to trade these markets as opposed to just hold them.
Light crude is under $60 a barrel. Does it look like light crude oil is in a bear market?
Well, it definitely looks like has been in a bear market for quite some time. The most recent phase of that I described back in August. You and I had talked about it too, but I had all these timing indicators coming together in late September when I thought that crude would peak, that it should see a quick rally into that late September time frame. And then the next phase was a decline into January. So really we're at what I believe is the tail end of at least that 3 to 6 month and even 6 to 12 month bear market. And I'm looking more for signs of a bottom here and even some potential buy signals once they are triggered. They haven't been yet, but the stage is being set for that. And you've got some of these technical indicators I use and describe in my publications that are starting to take form and become poised for buy signals, but that doesn't mean they've triggered anything yet. It doesn't mean that a final low is even in yet, but that the stage is being set for that.
Natural gas had a great move into early December. Since then, natural gas has had a significant pullback. Where is natural gas in its cycle?
Natural gas has, on a continuous contract basis, on a cash basis, it has been slowly forming a bottom since a year and a half ago when it bottomed out around the 150. And then it set some secondary lows in third quarter of last year. I believe it was around 240 or so. But coming into the fourth quarter, there were some weekly and some monthly cycle progressions that I was describing to my readers, and one of them was during the first week of December that I thought we would see a multi-week high set, and then that should lead to some successive highs. Now, that cycle itself doesn't tell you whether they are higher highs or lower highs. That's where price action has to clarify that. But that cycle progression showed that after early December, the next important high should be in late January, and then again in March. And so natural gas, as you said, had a very sharp sell-off from there. So the late January cycle high is probably going to be a lower high. But coming out into March and April of this year, I expect to see some higher levels than, probably higher than those December highs. But natural gas is just in, like I said, more of a basing and bottoming phase on a multi-year basis. And it's going through those initial rallies and sharp pullbacks, and then rally, and then another sharp pullback, and hasn't given more indication of a larger magnitude bottom or buy signal just yet.
What's the latest on agricultural cycles?
Well, they certainly run the gamut depending on which ag you're referring to, but livestock cycles are showing some signs of imminent peaks, whereas some of the grain markets, particularly corn right now, from a technical price perspective, is in the most constructive setup right now. From a cycle perspective, soybeans and corn had some very significant multi-year cycles coming into play last fall, actually right around August, and so they set what should still be some very significant lows there. But kind of like just talking about natural gas and even some of the other markets we've talked about, that it's more been a slow bottoming phase, and now you've got some of the technical price action on not just daily basis, but on a weekly basis, and in corn starting to form on a monthly basis. But it's showing some signs of life and getting close to the point where you could see a decent rally in at least the corn market, but I would expect to see the others go along with that too. So whatever factors might trigger that will probably trigger all of them.
LIT, the lithium ETF, has been moving higher. Is the LIT showing cycle signs that can help predict where it's headed?
Well, I probably sound like a broken record, but I keep going back to the same thing with the discussion on lithium, and that is that the LIT ETF is its stocks, and so it moves like the stock market. And so it bottomed back in April. It has been moving higher ever since. It's had a series of initial or intermediate highs in October and November. And similar to the overall market, there's signs showing that mid to late January could see a more significant peak. And that's regardless of where lithium actually is. That's more these related stocks and this ETF.
Where can listeners subscribe to Inside Track, spelled with two I's?
They can go to our primary website at InsideTrackTrading.com. That is inside with the extra I in the middle, so it's INSIIDE, TrackTrading.com.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. Coming up, Hilliard MacBeth, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, MacBeth.McLeodPartners.com. He's speaking to us from Edmonton. Welcome back to This Week in Money.
It's great to be on your show.
Can you tell us about When the Bubble Bursts, where people can buy it, and all that kind of stuff?
So it was written in 2018, so 7 years ago, and now what I describe in the book, the reasons for it, the debt and the housing price bubble, it's all happening now. So a little bit early, but it's turning out to be very accurate, and so it would be very helpful to people to read it. And you can get it in all the bookstores and online and in ebook form, and it's easy to find. And I'm on Twitter, or X as it's now called, HMACBE, and a little bit on Blue Sky and Substack as well.
The big story, Venezuela, U.S. forces grabbing Nicolas Maduro, the unelected president of Venezuela. There's a number of theories on why this was done by the U.S., including oil, gold, silver, other resources, drugs, Smartmatic, China's involvement, and a hub for terrorist activity directed at the U.S. Venezuelan oil production under the control of the U.S. versus oil from Alberta being sold to the U.S. Should Canada and Alberta be concerned with this action in Venezuela?
Well, for sure, Canada and Alberta especially are concerned because 4.2 million barrels a day leave Canada to go to the U.S., and they're sent to refineries that specialize in particularly heavy type of high viscosity oil. And Venezuela has basically the same kind of heavy oil. So if there's a big increase in Venezuelan oil production, then Canada's at risk. Now, a couple of caveats there. One is that the Venezuelan oil would go to the refineries on the Gulf Coast, and most of the Alberta oil goes to refineries in the Midwest and doesn't go all the way to the Gulf Coast. And there's no pipelines to take the oil from the refineries on the Gulf Coast up to the north. So, it should be safe for a while. But the bigger issue is what happens in Venezuela, because, as you mentioned, Maduro was elected in a highly questionable election re-elected, I should say, in June of 2024. Some people, independent observers, think that the opposition got 3 times as many votes as he did, but somehow he hung on to power. And it's a failing state. I mean, the poverty levels are above 60%. Extreme poverty is the word I saw. It's sort of hard to imagine. The corruption is off the charts, so the U.S. moves in, removes Maduro on charges of narco-terrorism, and not sure what that means. Now here we have. We still got a country that's in very dire straits. Very close to Cuba. There's a huge interaction between Venezuela and Cuba. The Venezuelans really looked up to Castro, and then after he died in 2016, the relationship stayed very close. A lot of oil goes from Venezuela to Cuba. Cuba needs oil, and they buy it from Venezuela at a discounted price. But what are the immediate goals? So you'd think that Trump would have said on Saturday when he went on TV there that he wanted to restore democracy to Venezuela and do something about the election result in 2024. But he didn't even mention that. He just mentioned oil. So he mentioned oil multiple times, and he mentioned drugs several times as well. And when it came time to decide who was going to be the interim leader, he picked the vice president of Maduro, who was also part of this corrupt regime. So that was a real big surprise to a lot of people. And because there is an opposition, they did collect a lot of votes. They just didn't get to take over the government. And so what are the chances that Trump could be successful? Well, you mentioned China. Well, China buys a lot of oil from Venezuela in Venezuelan terms, about 400,000 barrels, which is 40% of the million barrels that Venezuela exports. So that will hurt China a little bit because they'll have to pay a higher price probably to buy it. But it won't be a problem. It's not a huge amount of the oil that China needs. It's a small percentage. Cuba could be hurt quite badly if the U.S. restricts those barrels exported to Cuba, as they really need them, and they need a lower price on them as well. So there's a couple of things happening there. But how will Trump be judged on this action? It's hard to imagine. I think it's a pretty bold initiative, and there's one possibility. It's not looking good so far, but we're only a week into this. If he could have framed it as an attempt by the U.S. to take a regime that's corrupt and illegally in place and move it to a democratic elected regime with less corruption and help them establish a new thing, he might have made it look pretty good. But unfortunately, he mostly talked about oil, and then he talked about bringing American oil companies in. This is where it gets really dicey. And he says that whatever money they spend, because the oil fields in Venezuela have lacked investment for decades, so they need a lot of infrastructure and new investment. But the oil companies would be risking a lot if they put that money in there, because they don't know if who's going to be in charge or whether they'll be protected or not, and sabotage a new regime that just nationalizes the assets. I mean, there's all kinds of possibilities that would be bad for the oil companies, and so they are absent from the announcement. They're not rallying, and they're putting their name out there saying, yeah, we're ready to go in. So Trump actually said a couple of days after the invasion, he said that the government of the United States would reimburse the oil companies for their expenditure that they put in there. But I think he's going to have trouble getting them to go in. So where it is in history is a couple of decades ago, Chavez, Maduro's predecessor, took over. 1999, he took over. And somewhere around that time, oil production in Venezuela peaked at around 3.5 million barrels a day. They're down to 1 million barrels now. So they've got a long way to go back up to there. But it's going to take at least a decade and probably $100 billion U.S. dollars to do that. And the question is anybody willing to take that chance? Because you put $100 billion in, you get back up to 3 million barrels, and then a new government takes over and nationalizes it again, like they did in the 1990s and the 1970s. So it's a very risky situation. So I don't know what's going to happen. It's really up in the air, and I think the military must feel really good about the success of their ability to capture that Maduro and get him back to New York. But unlike Carter's attempt in Iran in 1980, where the helicopters crashed, this was very good, and it was risky because if it had gone badly, it would have really reflected badly on Trump and his government. So he may get lucky again, and I understand that Rubio, the Secretary of State, is very interested in Cuba because his parents are from Cuba, and he would really like to restore a non-socialist government in Cuba. So they could pull it off. It would be an amazing coup if they could, and we'll just have to see. But in terms of getting back to Alberta oil, because that was a big part of the question, Alberta exports 4.2 million barrels a day. The U.S. buys very little oil from Venezuela. Even if it went up by a couple 300,000 barrels a day, it's not really going to impact. In the short run, it's really going to have very little impact on Alberta. In the medium and longer term, the bigger risk to those exports to the U.S. is the fact that demand has leveled off. In fact, it's shrinking. The demand for crude oil is shrinking more slowly in the U.S. than in other parts of the world because shift to electric drive for cars and trucks and buses is going very slowly in the U.S. It's going very fast, very quickly in China and Europe and other places. So if that changeover to electric drive comes in the U.S., the 20 million barrels a day they burn could come down to 18, 17, 16 million, 15 million. And then the most likely barrels to get dropped off would be the Canadian barrels because they're difficult to process, and the U.S. is the largest producer of oil in the world, so they would find that they didn't need our Alberta soil as much. So that's the bigger risk, I think, than Venezuela.
Is the availability of additional oil likely to be bearish for the price of oil?
Yeah, it's an interesting question because when they first announced this, you'd think that the price of oil might have jumped up because it was largest oil reserves in the world, but it actually went down. Went down to $56 on the WTI, which is a very low price over compared to the last few years, and it's bounced back up as we speak here on Thursday. To 57, 58. So the price of oil has not really moved around much at all. And I think there is a supply glut. There's about 2 million barrels extra in the oil market worldwide. Of course, it's not just one market; it's a bunch of different markets. But and OPEC is meeting soon, but the big meeting for OPEC is in March. And the question is, they would love to. They've been curtailing their production. OPEC has to try and keep the price from dropping further, but there's still an oversupply, and they were hoping by March they would be able to tell people that they can restore their production to higher levels. But we'll see. March will be the big time there, but generally it's headed towards surplus because of the most crude oil. About more than half of it goes into transport, whether it be cars, trucks, planes, trains, that sort of thing. So if some of that gets moved over to electric, it's going to take decades for all of it to move to electric. But if some of it moves to electric, then there's going to be some barrels that get lost out of that demand equation, and surplus might persist for quite a long time.
Would lower oil prices be good for the U.S. economy and stock markets?
Well, I certainly think that the President Trump is interested in lower oil prices. He correctly realizes that for the midterm elections in November, if the price of oil comes down, especially if he can somehow claim credit for that, of course he won't legitimately claim credit. He claims credit for a lot of things, that whether he's responsible or not. But anyway, he could, if he could legitimately claim credit for it, if the price of gasoline came down. That's something that people see every day when they fill up their trucks. So, and the elections are not that far away now. So, a drop in the price of oil would probably help. But on the other hand, it's a huge industry for the U.S. They produce over 13 million barrels a day, by far the largest in the world, and it's a big industry. So they're exporting a lot of oil now too. They're importing 4 million barrels a day, from 4.2 from Canada, and they're exporting 1 or 2 million barrels a day as well. So big industry, and so I don't know if it'd be overall good. It'd be good for parts of the economy, it'd be bad for other parts of the economy. It'd be kind of a mixed bag.
Canada is being economically destroyed by federal and provincial politicians. Change my mind.
Well, first of all, they don't have that much power, right? So politicians come and go, and they get elected sometimes for a short time, and then other times they get elected for, say, 10 years. It's usually about the longest they stay in. But in Canada, because we got so many levels of government, we used to have 3 levels: federal, provincial, municipal. Now we got 4 levels. We got the First Nations level now. So it's very difficult for one individual politician or 11 politicians to have much impact. They don't act together. They don't always agree, and there's some huge challenges. I mean, President Trump has way more impact probably on Canada's prospects than any of the individual provincial or federal leaders have in Canada. So the big issues are the renegotiation of the North American Free Trade Agreement, or CUSMA, or however you're supposed to say it, and it's coming up in June of this year, so it's less than 6 months away, and it's not looking good. I mean, the mood of Washington is definitely not in favor of giving Canada any kind of a good deal. So that would affect a lot of industries, like the auto parts and auto manufacturing industry, and a whole bunch of other. There are right now, as long as the existing agreement is in place for another 6 months, most of the tariffs that have been announced in the headlines in the paper are actually not impacting Canadian business. As long as you fill out the paperwork and you can claim an exemption under the free trade agreement, you don't. I hear the paperwork is quite challenging but it's worth it because you get those tariffs down. So, for instance, European cars like BMWs, Mercedes, they have 15% tariff coming in to the U.S., but a lot of the Canadian cars go in there tariff-free. So it's, but that may not last much longer. So it's that's a big issue. And then, of course, what happens with this oil business is I downplayed the impact of Venezuelan oil, but in the short run, but in the longer run, the impact of electric cars plus Venezuelan oil plus the glut from other OPEC producers. Our barrels are expensive and they're hard to refine because of the nature of the oil. We got diluted bitumen. You have to send diluent with it, and then you have to get it back. So you have to build a second pipeline to recover it, and because diluent's expensive. Oil from the shale in Texas, to West Texas, shale oil is so. It's such high quality that you can actually put it directly into your gas tank without any refining at all, and it won't hurt your car. You can drive away. So now they do refine it because they can make it better, but it's completely different product from what we send down there. So those are some of the bigger risks, short to medium term for Canada. I don't know that any provincial or federal or municipal politician can do much about that.
Home sales in Canada seem to be drying up. Are home sales the canary in the coal mine for home prices?
Yeah, usually the volume precedes price. So in the stock market and in the housing market, the thing is, in the housing market, you don't see this very often. This is very unusual. Like since 2022, late 2021, early 2022, when the market peaked in Toronto, the average price is down about 20%. It's actually down more than that with inflation and that, but that's the headline number. And it's very unusual to see so many years now. We're into our fourth year, just starting our fourth year of decline, and it hasn't happened since the 1990s. So it's 30 years plus. So it's hard to say for sure what it means, but in normal cycles, you'd have a standoff like this where the sellers are still thinking of that price that they could have gotten in 2022, $1 million for their townhome, and now it's the best probably price they can probably get it is $800,000 or $750,000. Well, they're just very reluctant to take that hit. In fact, there's a lot of cases they can't afford to because they would still owe money on their mortgage. In 4 years they don't pay down their mortgage enough to deal with a $200,000 loss. So they hang on. So that's why there's no transactions, because the buyers are quite aware that prices are down 20%. They would actually like them to be down 30%. So they bid 30% low. They build, in that example, they would bid $700,000. The seller is still thinking million. So that's such a wide gap. There's no way to bridge that gap. And I think in the end, the sellers will have to change their prices lower. And if they don't do it, then the people that lent them the money, whether it be a bank or a credit union or these private lenders, will force them to do it. And I saw a study this week that said that there's been quite a big increase in what they call power of sale transactions or foreclosure, because some parts of Canada call it foreclosure. The increases mostly come from those people that lent second and third mortgages behind the first mortgage, which the bank normally would have the first mortgage. So they're the ones that are triggering these forced sales, because they want to try and recover the title of the property before it goes any lower. But so far the banks have not taken much action. But if it goes much lower, then it gets into the bank's portion. So say the banks lent 70% of the 2022 value. Well, it doesn't have to go down a lot more. And now you're starting to get into the bank's part of the thing, and they can move quite quickly when they move. And the thing about the banks is their attitude's different, because they just give it to a seller. They just sell it. They don't care what price. It's a completely different transaction, and just get rid of it, because we want to get that off our balance sheet. So as far as I know, I haven't seen any indication that the banks are moving quickly now. They tend to hope for the best and think that, and it's true. The experience has been that the homeowner, even if they're underwater in the mortgage, they will keep making their mortgage payments. And as long as they do, the banks be more inclined to just let them carry on and not foreclose. But if they do start foreclosing, that'll be another leg down. And in my book, I predicted it could be 50% decline, which would be another 25 or 30% from where we are here, and that would be a crash, not a correction, but a crash. But it would require that the banks get involved for that to happen.
Real estate prices in Canada are starting to drop in your book when the bubble bursts. At what point in the real estate cycle are home prices likely to do a ski hill-like drop? And what could the price percentage of that drop be?
Yeah, so that's the big question, is the ski hill. I'm not sure if that question implies like a ski jumper. You see those guys. It's coming up in, I guess, less than a month now. We're going to have the Olympics, but so we're early in on the thing. I think what I was saying a minute ago about 25% now, we could have another 25%, which would be and the thing that about that last bit, it sounds like 25%. Well, yeah, but the last bit is much more ugly than the first bit. The first 25% is like, well, most of those people, if they bought in 2015 or something, they still got a little bit of profit in it. But another leg of 25%, the people who bought in 2022, they're already way underwater. But most of the people didn't buy in 2022. Most of them bought earlier than that, and so this next leg down would be what would cause much more anguish in the market, and that would be where it would become the bubble completely bursting. By the way, when I wrote the book, I read some stuff by a very smart guy, Grantham is his name, and he said that all bubbles burst, and they all bubbles burst completely. Now, he was talking about the stock market, so the real estate market may be different, but he went through a bunch of bubbles, and he had a staff. Unlike me, I did all my own research, but he had a big staff, and they identified, I think he said 30 bubbles or something like that, and every single one of them completely eliminated the excesses that have been built up during the bubble portion. So that would indicate a very, very large correction. Even from here, still another 30% or even more to get back to the trend line that would be in place. And every week we put out a graph that shows, every month, once a month the numbers come out, the house prices. They have been coming down now it's close to 4 years. But the gap between how much inflation has gone up and how much wages have gone up is still very large. So for a fully burst bubble, you'd have to have that gap eliminated, or at least mostly eliminated. That implies quite a large further correction. Wages have come up. There's no question. Wages have come up over the last 20, 25 years, but they haven't come up anywhere near as fast as houses. So houses have to come down. Wages never will go up fast enough to catch up to the double prices in housing. So the other part of the correction has to be, most of it has to come from house prices coming down.
If the real estate bubble is finally bursting here, what could it mean for lenders and the big six banks?
So I mentioned that the banks haven't really gotten involved in this yet, and it's actually quite fascinating. The banks, the Royal Bank of Canada, the share prices continue to go up and up, and they haven't taken any large loan loss provisions for losses in the bank. I mean, they don't have as much risk in housing as people think they do, because a lot of their loans are either only 50% of the value of the home. So even a 40% correction isn't going to touch them that much. Or they've insured them with CMHC or one of the other two mortgage insurance companies. And if those companies take the loss, so the insurance is that they would take the loss if the bank forced the sale because the mortgage was at risk. Then if the house, when this house sold for less than the mortgage, they would claim that difference on the insurance. So the bank doesn't have that risk. So, but what would hurt the bank a lot would be the loss of it's their biggest business line, right? So it's like 65-70% of their business is retail, what they call retail banking. So that includes credit cards, home equity line of credit, car loans, and mortgages, right? It's all to do with the household. So obviously, if a significant number of households are getting in trouble with their mortgages, they're going to be in trouble with their car loans, their credit loans, credit cards, and all the other stuff, or they're just going to stop borrowing money, and that's where the bank would really start to hurt. And in Canada, because of the way the rules are, the banks are highly levered to a household because most of the borrowing is mortgages, and because of the way the rules work, as they've evolved over the last 50 years, the banks don't have to keep very much capital at all for mortgages. They do for other regular business loans. They have to keep what they call 100% capital on regular business loans. For mortgage loans, if it's insured, it's 0% capital, and the rest of the loans are probably like 8-10% capital. So they don't have much of a buffer on mortgages. They got, if you take away the insured part, you've got 10-to-1 ratio. So once they get into that part of the house price decline, where the house has gone below what the bank mortgages, the banks start to lose money very quickly. And we're still a ways away from that. It would take another 20 or 30% decline in house prices to get into that portion. But some people have already gotten into trouble, but for the majority of the people, it would take a bigger decline for them to get into trouble. If that happens, then the banks will become undercapitalized, because the rules are quite strict about that. They would have to raise equity capital. The rules changed after 2009. They're not allowed to borrow their way out of it. They used to have 4 or 5 different kinds of capital, but now the common equity tier 1 capital is the main buffer. And of course, if they start making losses on their mortgages and then their car loans and all that, then that comes out of capital. But they've got a lot of stuff they can do before they get to that level. So first of all, they pay these very generous dividends. So they could suspend dividends now. The Canadian banks have been paying dividends steadily they're very proud of this, because they're probably the only banking system in the whole world, on the planet, that this is true. They haven't ever suspended their dividends. Everybody's like, in 2009, all the American banks suspended their dividends, and British banks. Anyway, Canada's the one area that they never suspended their dividends. And so if they suspended their dividends, that would really help build up capital, because that money they pay out in dividends comes out of the capital account. They could raise money on the stock market, but that would mean they would be selling stock at much lower prices than they're trading at today. So that they'd be reluctant to do that, but they might have to. So they would be forced by the regulator. OSFI is the name of the regulator, Office of the Superintendent of Financial Institutions, OSFI. they have very little backbone when it comes to the regulated banks. The banks are much more powerful than the regulator in Canada, actually in every country, but especially in Canada, because Canadian banks have managed to avoid being in trouble. So, but in the event that they get severely undercapitalized, the regulator would step in and say, you have to increase your capital, and we want you to suspend your dividends, and we want you to raise money on the stock market. And the banks would have to do that. And so I'm going to get to your question here. That would all have to happen first before you would get to that bail-in thing, which was part of the question. So people are very worried about this bail-in thing, but it's really not likely to be an issue. And you'll have lots and lots of warning, because you'll see, first of all, the banks would have to stop raising their dividends. Almost every year they raise their dividends. Secondly, they would have to suspend their dividends. That would be the biggest clue. And then they would be raising money on the stock market, and they'd be screaming about being forced to do all this by the regulator. So and then after, if all of that failed, then you'd have the possibility of bail-ins, but it's very unlikely.
Appreciating home prices have allowed people to borrow against equity in their homes. What are banks and lenders likely to do if that home equity disappears?
Yeah, so that's been the whole story the last 50 years in Canada, right? So it's like people are living off the equity in their homes, and now the equity is shrinking rather than expanding, and so it's a whole new ballgame. It's, as I mentioned, it's 4 years old. It's got a lot further to go. I don't really think, from what I can observe, that the households or the banks have really come to terms with this yet. I think both the household, the borrower, and the lender, the bank, are sort of hoping that it's going to be over pretty soon, and then we're going to go back to where we were, which is understandable, because in the previous downturns we've had, like 2020 and 2009. To go back to the two most recent ones, that's exactly what happened. Prices went down a little bit, not as much. This downturn is bigger than either one of those two big downturns. And things went back to the way they were. There were very limited. There were no widespread problems in the households being unable to pay their loans, and so I think that's what everybody's kind of holding their breath, thinking that we're going to get through it this time. But I met these guys that do these, the superintendent of bankruptcy trustees, and you have to, it's like an 8-year course you have to take or something, and then they've got this business in Ontario at 30 branches. Well, they got their finger right on the pulse of this thing. And they're saying they're seeing something they haven't seen for 20, 30 years, which is people that own homes are coming in to look into, there's two stages: consumer proposal and bankruptcy, and they're in to get out of your debts. And they're starting to see homeowners come in, which never happened before. Before, up until recently, it was all renters and people who didn't have any equity in their home stuff. But when the homeowner actually comes in, that means he's probably got no equity left in his home, and he's still got all these debts, right? So it's going to slow down retail spending, slow down restaurant spending, slow down vacation travel. It's going to slow down car sales. It's going to hit everything, because people generally, they'll just sort of batten down the hatches and go to the mattresses and stop spending money. And most of the people, 90% of them, will get through it and live to fight another day. The 10% that don't get through it, they'll have to declare bankruptcy or do something like that. And it's not going to have bankruptcy used to be a very shameful thing, but now I think it's less of a stigma. And if that's where it's headed, people, are reluctant to take that step, but it probably is something worth considering if you're that deep into debt.
In 2009, then Finance Minister Jim Flaherty, rest in peace, and the Harper government made bank bail-ins legal, but said we'll never use them. Should we now be concerned about possible bank bail-ins?
Well, it's interesting, because everybody thinks of Jim Flaherty and Flaherty and Stephen Harper, but what they did was, and I wouldn't have known this before I wrote my book, but they just did this massive behind the scenes bailout of the banks. So the banks had all these mortgages. 2009, nobody wanted to invest in mortgages. Even the good mortgages in Canada that were insured by CMHC, nobody would touch them, right? So because all these U.S. mortgages were subprime and they were failing, and there's all these bundles and stuff, and Canada had its own problem in the asset-backed security commercial paper thing, and so they brought in these programs. One of them was a $110 billion, it's the largest ever program in the history of Canadian government to buy these mortgages from the banks, and they did that, and that freed up the banks to then go out and make a bunch of new loans. And so what happened was, in 2009, in the U.S., house prices went down 38% on average. In Canada, they went down about 5 or 10%, and then they immediately started going back up again. So this was genius. Like, this was amazing. It allowed Canada and the Canadian banks to keep going. And as part of that deal, I guess they felt that they should put a little pressure on the banks and say, well, we're going to put this extra burden on you for this bail-in thing. But they're right. I mean, they're not going to use it because, from 2009 to 2026, that's 17 years, the banks have built up a lot of profits, a lot of equity. So the price of housing has gone up probably double or triple. So they've got a lot of cushion built in from 2009. But very few people know about that rearranging that Harper and Flaherty did. And there was a guy working in the Department of Finance at the time named Mark Carney. So you really want to think about conspiracies, there's one for you. It's like, and I honestly don't think, I think Flaherty was a lawyer from Oshawa, Ontario, and I honestly don't think that he would have been able to figure out this mortgage program that they put in. I suspect Carney probably had his finger in it, and it was a genius move. And in my book, I write about it and say I think it was unfortunate that they did that, because I think Canadian banks and Canadian housing would have been okay. They wouldn't have been as bad. They weren't as bad shape as the U.S., but it would have been good for the system if they'd been allowed to suffer for a little bit longer through this big global financial crisis, GFC as they call it, because now they immediately acquired a feeling of overconfidence. The borrowers and the lenders both felt that the system is bulletproof, and no system is bulletproof. So that was unfortunate that they did that, but it would help the Canadian economy, and it kept us going for another 15 years until we're hitting the wall again. But this time there's no bailout coming, I don't think. So it's going to be much more difficult this time around because the declines are bigger, and there isn't that opportunity to bail out the banks and the housing system like there was in 2009.
Commodity prices are moving higher. Do you think we're now in a commodity bull market, and how long do commodity bull markets usually last?
Well, that I was looking at the price of one copper company called Freeport McMoran, and they also have some gold assets too. And of course, the price of gold is going way up. Our gold mining stocks have tripled, and it's been in a very short period of time. Like, we owned them for years, and the price of gold went up to $1,200, $2,000, and the price of the gold shares never moved really very much. And then just now we're at $4,500. The costs for these gold mining companies are still around, back then, 5 years ago, was $1,200. It's probably maybe $1,400 an ounce now. So the profit margin is like $3,000 an ounce. And that's why these companies, Barrick was $15, now it's $45. And Agnico Eagle, similar, and Newmont, and some others. So, and some of the little ones, which are riskier, have gone up even more than that. So, and silver has gone up even more than gold. I don't have the exact numbers in silver in my head. And now copper's hit another high. Copper's at like they do it at $9 per metric ton. So that's like around. Anyway, I'm not sure exactly, but copper's made a big move up, and so is nickel. So we are in a commodity move, but you can't really equate gold and copper and nickel. They're completely different commodities. Gold is a financial commodity, and it's like Bitcoin or something like that. It's entirely based on what central banks do and what the investors do, that sort of thing. Copper and nickel are more about demand. And what's interesting about it is copper used to go with house building, because there's a lot of copper in a house, as pipes and everything, wiring. And now it's electric cars, and same with nickel, the batteries. So the batteries for electric cars, nickel, and the copper for the wiring for electric cars, huge wiring, and everything electric has got huge wiring. So that's what's causing the demand. I think it's I don't know, at the current prices, it's had quite a run, so the current prices might have gone too far. But I think we're in a long-term uptrend. The only risk is for the battery, like lithium, cobalt, nickel. They've mostly removed cobalt from it, but some other substances. There's always the possibility of a big breakthrough in batteries that might change the equation. But the way things are now, if there's no significant chemical breakthrough, those commodities should do really well.
It looks like the economy is causing auto sales to slow, or electric vehicles still maintaining their market share even though sales are slowing.
Yeah, so everywhere in the world but North America, electric vehicle sales are soaring, right? So Africa, Mexico, Latin America, Europe, and especially China. So in China's the biggest. So now China's the biggest car producer in the world. Worldwide is 100 million cars produced, roughly, and China produces like 20, 25 million, some big number like that. 53% of them in the recent numbers were battery electric vehicles. So it's compared to North America, where it's still under 10%. And in Europe, I forget the exact numbers, but it's probably around 20, 25%, something like that. It's heading much, much higher. China's in the lead, and it's just going to go because they're better vehicles and they're cheaper. So it's going to start really having a big impact on things like the demand for oil and also resale value for cars, because if these new, we're not allowed to buy them. Well, I don't know if we're allowed to buy them, but the tariff's 100%, so nobody's going to buy them. But the Chinese vehicles are better than what we're getting from Detroit and GM and that sort of thing. And there's 100% tariff on them. It was actually brought in by Biden, and then Canada had to match it, right? Because of the auto pact, the trade agreement, Canada put 100% tariff on China as well. So Chinese vehicles are and that's fairly recent. It's only in the end of 2024 that came in. So all these new vehicles that are coming out in China that are 100% battery electric, not hybrids, just pure electrics, are going all over the world, except North America. They're not coming to North America. So everybody, I follow a lot of people on X and other places and podcasts and stuff, and they all make a very convincing argument that it won't last forever. It won't even last that long. We're protected from being able to buy these cars for $25,000 each that are better than what we're paying $40,000 for. Eventually they'll have to find their way into North America, but for now it's mostly just everywhere else in the world.
Hilliard, where can people follow you, and where can they buy your book?
So they can buy your book, as we said, anywhere in the best bookstores and online, the Kindle and all the other Kobo e-book readers. And there's 2 editions, so look for the second edition, more recent one. It's got a red cover, and I fairly active on X, and each week we bring out the weekend note, which usually I write. Some of my other colleagues write them from time to time. This week it'll be on the invasion of Venezuela. Comes out on Friday, and you could sign up for that by email, and then we'll keep sending you once a week that stuff. And you can follow me on Twitter at HMACBE, or sorry, X. I shouldn't say Twitter. And yeah, I hope you enjoy. In the middle of the month, we bring out that. Been doing it for years, but now it's getting more interesting. We bring out that chart, and we post it on X, which shows the house prices, the household debt, and the wages and inflation. It's got about 5 data series on the chart. It's quite interesting. It's getting more interesting now that there's been some break in the prices. So that comes out around the middle of the month.
Hilliard, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Hilliard MacBeth. He was speaking to us from Edmonton. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Gerald Celente, Eric Hadik, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.